All right, everyone. I want to say welcome to all of the real estate investors that are joining us today for a multifamily market update. Today, we're going to nerd out a little bit. We're going to get into some data, not just real estate data, but we're going to get into some economic data to talk a little bit about what we're seeing in the real estate market. And of course, what type of signs we're seeing based on Fed data, economic data, unemployment, all the things you really need to know to make you a smarter investor. So, my name is Brian Alfaro. I am the Director of Investor Relations here today. So, we're going to be going through this slide deck, and I'm going to try to move as quickly as possible. I do have quite the number of slides. I once I got started building this and really updating it, I had a hard time slowing down. So if I skip over anything and you have a question, so just some housekeeping here, please, please, please put it in the chat, put it in the Q&A box. I will do my very best to make sure that we get to it. But without further ado, let's go ahead and get started. All right. So first of all, if you want these slides at the end of the presentation, just shoot us a text 281-559-7061. Just text me and just say, hey, Brian, I'd like to get the slides from today's presentation. You're going to see a lot of graphs and charts and different things of that nature. And you might be very interested in checking out that stuff. So if you want these slides, just shoot me a text. If you have my email, you can also send me an email at the end of the presentation as well. Just a quick disclaimer for everyone. Today's webinar is for educational purposes only. It should not be considered legal or accounting advice. I'll be expressing my opinion here today and what I think may happen based on what I'm seeing. But of course, consult your attorney or CPA or your tax professional before making any type of investment decision. This is not investing advice. It's just simply my opinion on what's going on in the market today. So a little bit about Headway Capital, just some quick information about us. If it's your first time here, I do see a lot of repeat participants, so really appreciate you guys joining. I also see some new names here that I haven't seen before, so welcome. My name is Brian, as I mentioned, but if you don't know about us, Headway Capital was created to help build and protect the wealth of busy professionals. So our mission is to provide investment opportunities that provide cash flow, equity appreciation, and tax benefits to help you, our passive investors, achieve that financial independence we all desired. We have lots of experience managing and vetting alternative assets such as multifamily. We all also started in the residential space, which is where we spent quite the number of years before we transitioned over to multifamily. Our founder and CEO and his wife, Sid Shamim, and his wife, Anam Omer, and they started investing in real estate in 2011 after the great financial crisis, built up a portfolio of residential homes, right under 40 homes, and eventually transitioned into passive investing, which is where a lot of people get started. It's a great place to start your real estate career. If you ever plan on being a full-time real estate investor, passive investing is a great place to start, which is what they did. And then they started actively investing as an active sponsor in these multifamily deals we put together in 2017. And as I like to say, the rest is history. Sid quit his full-time job at a oil and gas company, big oil and gas company here. One of the big names I'm sure you'd recognize. And Anam actually still practices as a physician to this day. Sid and I and Amar are all full-time here at Headway along with our team. I'm the Director of Investor Relations, so I have the pleasure of talking to all of our active investing partners that have invested with us in previous projects, and then also all of our prospective investors and partners that work with us as well. So if you haven't had a call with me and you'd like to see what it would look like to partner with us, my information will be at the end. Would love to chat with you and get to know you. I like building relationships with all of my investors because I think that's crucial. When you're investing with somebody, and that's what separates us from, say, a REIT, for example. You get to know us. And then last but not least, Mr. Umar, he's our CFO. He's a little under the weather, so he's not here today, but Umar is the numbers guy. He's the Excel wizard to make sure not only are we buying good deals, but that they're actually performing. He's long experience in the multifamily operations and financial management space. So that's us. These are our core values. We really value transparency, integrity, staying really lean, which is important for our investors. We don't like buying stuff just to buy stuff, which could affect NOI, which affects the property's valuation. We hold ourselves accountable to really high standards and take responsibility for our actions. And we always put our investors first. And that's what helps create the Headway difference and has helped us build our portfolio. To this date, we have right under $500 million of assets under management, right under 3,000 units. and right over 500 investors that have invested with us in the past as we target that 25 to 30% average annualized return. And these are some snapshots of some of the assets that are in our portfolio, as well as some testimonials from some investors that have worked with us before, that know us. So always happy to share references if you're interested in investing with us. And these are the types of projects that we do. These are 3 assets here in Houston that were all acquired prior to 2022 that are in our portfolio that we are managing and operating with our in-house property management company today. Happy to share more info if anyone wants to take a look at our track record. Just feel free to reach out. So let's dive right in. I don't want to waste any more time talking about us. Let's talk about the multifamily market, or let's just talk about the market in general. So let's talk data. So hopefully I don't bore you, but hopefully you'll like data, because I'm going to share some really interesting graphs and charts, and I'm also going to share my opinion on how I think these impact the real estate market as well. And of course, we will talk specifically about real estate and what we're seeing in the market today. So let's talk about the elephant in the room. When we talk about data today, I think the number one thing that everyone wants to talk about, or has wanted to talk about, really since 2021, when it started to rear its ugly head, is inflation, right? So the good news is, as we stand today, I personally believe, based on these charts that you see here and the data that we're seeing, that inflation is still here. It's not at that 2% goal that the Fed is aiming for, but it is definitely heading in the right direction. So you'll see a few lines here on the graph. If you're not familiar and you don't follow Fed data like we do and we nerd out about it, the Fed is always aiming for a 2% target on core PCE, right? So there's different levels of inflation. There's CPI, core CPI, and core PCE. Core PCE is the Fed's preferred method of inflation. And you'll notice all 3 are heading in the right direction. So inflation is slowing. And this chart's through CPI through June and core PCE through May. There's actually some data that gets released tomorrow. So I will be on the edge of my seat tomorrow to see what the Fed data comes out about inflation tomorrow. But the good news is inflation is starting to cool, which is a factor of the interest rate environment that we're seeing. So everyone on this call probably knows the Fed started raising interest rates early 2022. I believe they announced the first rate hike either in March or April of 2022. And their goal was to really kill inflation. And we'll talk more about, are they doing that? Or they are, but are they doing a good job? And did they act fast enough? And will they cut fast enough? So we'll talk more about that and sort of theories behind that as well. And as mentioned, good news is, if you really annualize the last 3 months of inflation data, you're going to see that we're really, really close to that 2% mark, right? For all 3 data points. So whether you're a CPI person, a core CPI person, or core PCE like the Fed is, we are really getting close to that 3-month annualized number of 2%. So we're going to get there sooner rather than later. The Fed has had their foot on the brakes, so to speak, for quite some time now, since 2022, with these rapid rate hikes that they did. And so we're getting to the point where inflation is, I wouldn't call it beat yet, but it is definitely slowing down. So how is that impacting unemployment, right? Unemployment is a number that we watch very closely here at Headway. And if you're a real estate investor, I definitely recommend you watch unemployment. One, it could affect you personally, right? If you still work a W-2 corporate job, we've heard all about the layoffs, and maybe you've experienced some layoffs in your company and you've seen it around from some of your peers, unfortunately. But unemployment is inching above the 2019 level, right? So, and we're starting to see unemployment creep up above 4%. So last print showed a 4.1% unemployment rate. And I will tell you that the Fed starts to raise its alarms when the unemployment rate crosses 4%. So if the next unemployment reading comes out and we're seeing either a flat 4.1 again, or we see an increase in unemployment to 4.2, 4.3 or higher, that is going to give the Fed a big, big, big kick in the butt to consider cutting interest rates. Why is that? And we'll talk a little bit about the Fed's dual mandate that the Fed has, but the Fed is responsible for maintaining job stability and unemployment or employment stability within the market. That's one of the 2 dual mandates that they have. So if unemployment gets to a percentage that is unhealthy, where there's too much job loss, not enough jobs on the market, it's their job to let their foot off the brake and put their foot on the gas, so to speak, by cutting interest rates to stimulate the economic environment. So companies want to start spending money again, and companies want to start building again. People want to start buying again, and jobs get created from doing that, right? So that unemployment print is probably the second most important one that I look at. Inflation, core PCE. This is the one I'm always waiting for. But the second one I'm always looking at is this unemployment rate. And another thing to consider with unemployment that I think is really important to mention, if you're an investor in residential real estate or commercial real estate, unemployment should always be on top of your mind. Why? You have residents, you have tenants. What happens when your tenants lose their jobs? Right. So it's not something you want to be in where we're seeing really, really rapid high unemployment, because that's going to put your ability to collect rent in a trickier position. It makes it harder, right? So it's really important that we keep unemployment in check, and that the Fed keeps unemployment in check, which impacts us as real estate investors, so that we don't have to deal with a lot of evictions, a lot of delinquency, people not paying their rent on time because they lost their job because they were laid off, right? So just another really important factor to consider, and something to keep an eye on when you're looking at month-to-month data. The other thing to keep an eye on is the amount of job openings that has to do with non-farm payroll, right? So it's really important to notice how many jobs are open. Are we heading in a position of job strength where there's a lot of jobs, or are we heading in a position where there's not a lot of jobs, right? Right now, unfortunately, as you can look at this, you see this chart, there is a slow decline in the amount of jobs up there. That means we are not in a good position, right? If people are getting unemployment is going up, meaning people are losing their jobs, and the amount of jobs we have are going down, that puts us in a tricky position that will likely be one of the indicators of a potential recession, right? So we're going to talk probably quite a bit today about recessions, and does this mean there's a recession coming? My opinion about if there's a recession coming. But if there's rising unemployment and there's declining amount of jobs that are open, that's a recipe for a recession, right? So we are seeing a decline in the amount of job openings on a month-to-month basis, and have been now since the peak. It looks like the peak was around early 2022, called February, March. And jobs have been declining ever since. And that's because companies are getting squeezed, right? People are spending less money. The PPI, which is the Producer's Price Index, which measures what it costs to produce stuff, is still high. It's really expensive to manufacture products compared to, say, 2018, 2019, and people aren't buying like they used to. So people are getting laid off, right? So there's less jobs in the market. So again, just another thing to watch, because again, if you have residents and you have tenants and there's not enough jobs opening in your market, and this is a national chart, not just like Houston, for example, but it's really important to know, like, are jobs being created? Are there jobs out there for your residents to go out and get jobs? Really important. This other piece of data that is really important to watch, that I think is really interesting to see, especially today, is the yield curve. So if you're not familiar with what the yield curve is, it's essentially a chart that reflects the difference between the treasuries, the 2-year treasury and the 10-year treasury. And why is this important? Why do we care what the curve is, the differences between the 2-year and the 10-year treasury? Well, the reason people care about this chart is that there's a really, really, really high correlation that when the yield curve is inverted, a recession occurs, right? So you'll see here, looking at this chart, all the gray bars that you see, the vertical bars, are recessions. And every time the yield curve drops below the basis line, which is right here, which means it's inverted, every time it uninverts, a recession is created. It's a really high percent. I don't believe it's 100, but it's really high. It's like 95%, right? So going back to times that most of us can remember, let's look at, the early 2000s is going to be your dot-com bubble. This right here, this great chart here, is going to be your 2008 great financial crisis, right? And which is a much longer recession than some of the previous ones. But every time the yield curve inverted, which you'll see right here, it uninverts and we get a recession. Right here, we've had one of the longest periods of yield curve inversion in the history. Right now, you'll see the gap between when the yield curve inverted and today is one of the largest in the past few decades. It is getting really, really, really close to uninverting. So I would encourage you, when you get off this call, or if you want to open another browser right now, just type in 2-year, 10-year Treasury yield curve. You're going to find different links to different charts, and you're going to notice today it is approaching uninverting. It's approaching that zero mark. And people are like, oh, that's great. The yield curve's uninverting. Well, yeah, that's great. But every time that happens, it means there's a recession coming, right? So that we are at that point right now. It has a really high likelihood, 95% chance that every time that happens, it could be a small recession, what the Fed is calling a soft landing, or it could be a much tougher recession like we saw during 2008, the great financial crisis, right? So we're at that point here today where the yield curve is about to invert. Does that mean the recession is coming? I don't have the answer to that, but chances say there's a high likelihood. Another thing that we like to keep an eye on that I find really interesting is consumer savings, right? So there's a lot of reports out there that inflation is, decimating Americans, and it definitely has, especially your lower income Americans, your lower middle class and your middle class. But there's also reports out there that people's savings are all gone and credit card spending is at a record high, which is also true. But it's important to also look at the trends when it comes to savings in money market accounts, because that's a form of somewhat liquid savings. And then also looking at savings deposits based on an inflation adjusted basis, right? So this chart you see here is inflation adjusted using May 2024 core PCE, right? So you'll see that from a savings deposit standpoint, even though Americans are definitely getting squeezed and still very tight, there is a ton of money in money market accounts. And there's still a healthy amount of savings deposits compared to the years prior to COVID, right? So yes, savings deposits are definitely declining. You'll see the decline here, and obviously the peak was when they were giving out, all the inflation. They were printing money. The Fed was printing money and giving stimulus dollars to all Americans due to COVID. And you'll see this massive spike right here at the mid 2020 when they started, sending everybody checks, and then everybody's savings got ramped up. It was great times. And then the Fed started raising interest rates here on March 2022. And that's when the inflation really got really high, 9% or more, and it really started to trickle people's savings. But on an inflation adjusted basis, we're still seeing a pretty healthy amount of savings, at least compared to pre-pandemic. Now, the one thing to factor in is, of course, costs are much higher, right? So even though people still have a healthy amount of savings, things are more expensive. So we do have about $4 trillion worth of savings built up between the savings deposits and money market accounts. So still in a really pretty good spot, still amount of consumer strength out there, which is why we're still seeing a healthy amount of GDP and spending in the market. Uh, Another thing we like to talk about when it comes to data that I think is really important and also very telling of a potential recession and the impact on a potential the multifamily market or the real estate market is home builder inventory, right? For sale completed homes. So this is a chart from Reventure, which does some real estate data, and it is the amount of completed, unsold, brand new homes, right? So right now, as of mid 2024, we have seen home builder inventory spike to the highest level since 2009. Right now, does that mean that the same thing's going to happen, and the housing market's going to crash, and you're going to see 20, 30, 40, 50% discounts on residential houses? I personally do not believe so. One, the bank's lending criteria compared to 2008 is very different. We're not giving out what are called ninja loans back then: no income, no job, no assets. They've done a much more diligent process of making sure people that do have mortgages are much more qualified. And I would argue most Americans, I believe it's over 60% of mortgages in America are sub 4.5%, right? So most people's mortgage is an asset. So even though we might see some price softening, I don't think it's going to cause a massive amount of foreclosures and really a big crash in the residential real estate market. But it is interesting to see that the last time home builder inventory spiked to this highest level was basically 2009, right after the great financial crisis. And we all know this is not a surprising chart. And this is because right now it's really challenging to buy a home with the current interest rate environment. The rates are so high that the average American who's probably buying a starter or second home, they either don't want to leave their current home because their mortgage is an asset. So why would I go buy a new one? Or they don't qualify because the interest rate is so high, their DTI just doesn't really put them in a position to buy a house. So basically, we're seeing a lot of new homes and they're just sitting there. They're not selling. So this is a really interesting chart to keep an eye on because if people can't buy, what do? they rent, right? So residential real estate is still in a really great position. And of course, multifamily real estate is in a really great position because nobody's buying new homes right now and nobody's buying existing home either. People are choosing to rent by necessity, right? So we talked a little bit already about the Fed mandate. The Fed has, and if you don't know this, just a quick refresh. So the Fed has two responsibilities, and then we're going to show some data on how this is kind of playing out. Keep inflation in check and prices in check, right? So we already talked about inflation and how the inflation is heading down and heading in the right direction, which is great. And their other one is maintain maximum sustainable employment, which we've talked about, right? So, but the one thing I do want to highlight is even though the Fed is doing arguably a pretty good job, inflation's dropping, unemployment is okay. It's not at a terrible spot, right? 4%. It's still in a pretty comfortable position. They don't like when it goes above 4, but it's not necessarily sound the alarms unless we rapidly blow through 4 and approaching 5. So we're still in a pretty good spot. But there's something really important to discuss that not a lot of people think about called the Fed lag. And the Fed has a really, really poor track record when it comes to they have a great track record when it comes to controlling inflation and controlling interest rates. They're, they bat 100%. What they don't bat 100% on and what they have a really poor track record on is doing it at the right time. They either do it way too fast or they do it way too slow. And this chart is a great example of what happened in 2021 and 2022 and the amount of lag that they saw. So let me illustrate here. This orange line is CPI. It's inflation, right? So inflation, the goal for the Fed is 2%, right? So the 2% mark was crossed early 2021. So at that point, there's a fair argument to be made that in early mid 2021, the Fed should have started raising interest rates because inflation was already taken off. I mean, look at this early 2021 here, and it just boom, it just takes off between 2001 and 2022, right? It goes from sub 2.5% to 6.2% by the beginning of 22. This whole time, while the Fed is seeing this, they got their hands in their pocket. We've probably all remember the term transitory. If you like to read the headlines, this was my favorite term. Transitory. Inflation is transitory. Don't worry about it, guys. The inflation's transitory. It's going to pass. Don't worry about it. Just keep buying, keep doing your thing. Business is awesome, right? Well, inflation wasn't transitory. And they realized that too little, too late. The Fed started raising interest rates, as mentioned, March, April 2022. And because they knew they didn't react fast enough, they had to go really hard, really fast, which is what they did with the Fed funds rates. You'll see here, March, April 2022, this thing took off like a rocket, right? They were raising rates as fast as anyone has ever seen in the history of Fed funds rate, right? Nobody's ever raised interest rates that hard, that fast. So this Fed lag policy, or the Fed lag, as I like to call, this has a downstream ripple effect. And what type of downstream ripple effect does it have? Well, I will tell you the Fed has a really good job, or has a really good track record of causing inflation. Not causing inflation, causing a recession. And why is that? Why does the Fed cause a recession? It's because they don't act fast enough. They have a really poor track record of raising interest rates when they need to. And guess what? They have a really poor track record of cutting interest rates when they need to. And that's because the economic data that they're looking at is always delayed, right? And I'm not just talking about, oh, what was last month? What was last month? The changes that the Fed makes when they raise interest rate or they cut interest rates have a long-term impact. Usually you feel them for 12 to 18 months, right? So if you wait to cut rates too late, you end up pushing the economy into recession that takes 12 to 18 months to get out of. Because let's say we go into a recession here in the next few months and the Fed starts to cut Fed funds rate, which they're forecasted to do in September of this year. Well, we're not going to feel the impact of the Fed funds rate cut until mid 2025 or Q3, Q4 2025. That whole time is going to be a really painful period where we get into a really tough environment because of the exact same thing, the Fed lag, right? They take their sweet time making decisions and they're always looking at rear looking data. So this Fed lag is really important. And what's also important to talk about is how long until a recession hits, right? What's the number of months from the last Fed hike to the start of a recession? So you'll see here different recessionary periods. These are all years that we saw different recessions here in America. Everyone remembers 2001, right after, like I said, the dot-com bubble, and 2001 was also the year of the World Trade Center, so it definitely put the economy in a tough time. But we all remember the Great Financial Crisis in 2008. So the number of months between the last Fed hike and the recession in 2008 was 18. As of today, we are now at 12, right? So we're definitely approaching the tail end. So if we beat 18, then that'll be a new record. But the question, in my opinion, is not if a recession is coming, it's more when. And then the second question is how hard? Is it a soft landing in a sort of mild recession? Or is it a hard landing and the Fed decides they want to do the same thing they did here and wait too long to cut rates? And now they end up putting us in a really, really bad recession because they waited too long to let their foot off the brake and sort of loosen monetary policy, right? So really, really important stuff to keep an eye on. And last but not least, talking about rate cuts is what is the market forecasting when it comes to rate cuts? So if you watch this regularly, you'll notice this number has went anywhere this year from 0 all the way to 7. I think the maximum amount of rate cuts, I think it was earlier this year that somebody said was on the table was 7. I will tell you that as of today, this is from a website called Kalshi, where you can actually bet on things like this, which is pretty funny. But essentially, it scrapes economic indicators saying what are people betting on when it comes to rate cuts. So right now, there is a 36% chance that there are 2 rate cuts this year. Okay. And there's a 25% chance that there is 1 rate cut. I think those 2 are most likely. There is a 27% chance there's 3 cuts if the Fed goes aggressive, but that 2 cuts is what most people seem to believe is going to happen this year. So there is essentially a very, very, very high likelihood. I don't want to say guarantee, but almost 100% chance that there is at least 1 rate cut this year. The only thing that would lead to them not cutting rates is if for some reason inflation takes a turn and goes back the other direction and starts to go up again. I do not see that happening. There is a little bit of a baseline effect, meaning we are now comparing interest. The inflation rate was already dropping this time last year, so the drop will be softer because we're now comparing it against a year's worth of data where inflation was dropping a year ago as well. But we still should see a pretty healthy number when it comes to inflation dropping, and we're going to see at least 1 rate cut this year. There's only a 7% chance that there's no cuts, which is just not very likely. So call it a 93% chance that there's at least 1 rate cut this year. The market is actually forecasting this. People are betting on it, which is, interesting, but we're going to see some sort of rate cut this year. So how is all this data, right? We just talked about a lot of stuff. We talked about rate cuts. We talked about recessions. We talked about the Fed lag and taking too long. We talked about there being a ton of homes on the market for sale. We talked about consumer savings still being pretty strong. We talked about the yield curve inverting, meaning a recession is likely coming, and the fact that unemployment is creeping up and there are less and less jobs on the market, even though inflation is dropping, right? So how does all this really impact commercial real estate? Especially, I'll share my opinion on some things when it comes to multifamily. So the first thing I want to talk about is lending, right? So how is all this data impacting the lending market? So the banking sector remains cautious and still pretty tight, to be quite honest, when it comes to lending standards, right? So when it comes to lending standards, you'll see here 3 lines: a construction loan, commercial loans, and then multifamily loans. And the chart is measuring the net percentage of loan officers tightening lending standards, right? So you've seen a tremendous amount of tightening, right? Now the good news is they are definitely getting a little bit easier, but they're still tight, right? So just if this chart doesn't mean anything to you, what I will tell you is that banks are definitely cautious when it comes to giving out loans for multifamily assets. Leverage is still very low, which is arguably a good thing, but also makes our job much more challenging because we need more investors to get projects done. The typical, loan you'll see in good times is probably, 80% leverage. which is pretty normal, 75 to 80%. Right now we're seeing more like 60 to 75, depending on how good the deal is. And lenders are just more cautious, right? So they're still giving loans out, but it's definitely impacting interest rates, and it's impacting the amount of leverage you can get. All this data that we're seeing in the market. The other thing all this data we talked about is impacting is that I want to highlight is that many loans that are scheduled to mature in 2023 have actually been extended. So this is really interesting when it comes to foreclosures, because I think there's probably a healthy amount of people on this call today that would probably have assumed at the beginning of the year that there was going to be blood in the streets. They assumed that the real estate market was going to crash. Both residential, commercial, multifamily, office for sure. There was going to be blood in the streets, right? The interest rates have really destroyed the appetite when it comes to investing. Well, many loans have been extended, right, when it comes to maturities, and that's because what we've seen is lenders have actually been I don't want to use the word extremely, but they've been more flexible than everybody thought they were going to be. And that's because these lenders often have very, very, very large books of commercial real estate on their portfolio. The last thing they want to do is answer to their investors and show that their book is all red, right? That is arguably the mistake that was made in 2008. In 2008, the lenders foreclosed on everyone. They took back the keys, not just for residential real estate, but for all asset classes. And they ended up with a balance sheet of way too much real estate. They had way too many piece property on their books versus loans. And what did they have to do? They had to sell all those properties at a substantial discount in order to get rid of them because nobody wanted them. Nobody had any money to invest. The recession just hit. They are not making that same mistake that they made in 2008. They're letting these loans, even though they're mature, they're letting people extend them. They're being, as long as you're a good borrower and you're executing your business plan, you're doing what you said you're going to do, you're communicating with your lender, they are being more flexible. They're allowing borrowers to extend loans, which has prevented a lot of blood in the streets, right? So as of Q1 of 2024, distressed assets make up just 6.4% of all commercial real estate debt, right? So that is really interesting and aligns with what I was just saying, is that even though a lot of people predicted there was going to be a lot of blood in the streets because of floating rate debt and different things of that nature, there's only 6.4% of distressed assets in the market right now. And this is from, if you're not familiar with where these charts are from, this is from a really highly respected and reputable mortgage broker, lender, and investment sales broker called Marcus and Millichap, which we have done business with a lot in the past. So their data is solid. So this data is really interesting to see. Like, this is a big reason why we haven't seen massively discounted properties, massive foreclosures. Are there some out there? Absolutely. We just acquired a deal that was in that type of situation, but we haven't seen blood in the streets quite yet. And with that being said, we talked a little bit about flexibility and what we're seeing in the lending side. Delinquency is also down, right? So delinquency remains in line with the historic norm. So again, everyone thought that the properties weren't going to be able to pay their mortgage due to the floating rate interest rates and things of that nature, but we're actually seeing so far in 2024 that delinquency is right in line with the historic norms, which is about 5.1%. Will it creep up a little bit as we get through the year? Possibly. Maybe we will see some tougher times Q3, Q4 of this year, but right now things are still in check. You'll see post financial crisis, right? So coming out of 2008, look at the amount of delinquency we saw in the market. And this isn't just for multifamily, it's just for commercial real estate loans in general. We saw 10+%, right? During the pandemic, of course, people weren't paying their mortgages, people weren't paying their rent. It was crazy times, 2020. We saw 10.3%, again, another 10%. Right now, we're floating around the historic norm of 5.1%. So still in a really good spot. But I like to use that as sort of a catalyst to discuss what can happen, right? So let's compare office, which is the asset class that's being hit the hardest right now, to say multifamily. So right now, as of April, this is data through April of this year. This is delinquency on mortgages for offices, right? So you'll see what happened in 2008. They creeped all the way up until 2011, 2012 into 10%. We had another little pop here in 2017, 2018 of 8%. And then right now, office is sitting at a 7.4% of loans in the office space are delinquent by 30 days or more. That means they haven't paid their mortgage. That's a really high number when you compare it to, say, 2008, right? So it's approaching the wrong direction. But what about other asset classes? What about two asset classes that are really popular, like industrial and apartments, right? Multifamily. Look at the delinquency rate in the industrial space, 0.4%. People are paying their rent. Even though times are tough, interest rates are high, it's not the fun environment to be in. We're only seeing 0.4% of loans that are 30 days or more delinquent. In the multifamily space, again, comparing it to 2008, 2009, coming out of the great financial crisis, we saw up to 16.9% of multifamily loans delinquent. As of today, going into April 2024, we've only seen 1.3% of loans delinquent, right? It goes back to this chart here of distress in the market in the multifamily space is very, very low. And that's for a variety of reasons. One, it still has a really high demand. People are still, we're still seeing high occupancy. People are still paying their rent. Is it stretching certain borrowers thin? Yes. There's not a lot of cash flow necessarily if you've invested in a property and unfortunately maybe it's not cash flowing. That's not ideal, of course, but we're still able to service the mortgage, right? People are still able to pay their mortgage and work with the lender to say, hey, we're doing everything we can, or we're 95% occupied. Yes, we are not in a great environment, but we're still doing the best we can. Let's work together, right? So it's put us in a situation where we've seen very low distress and we've seen very low delinquency. People are still paying their mortgage, which is great if you're still bullish on multifamily investing. And then last but not least, talking about delinquency, I like to compare sort of apples to apples. So among bank loans, multifamily ranks among the lowest delinquent sectors. So this is another chart coming out of Q3 2023. So it's about a year old, but it's a really interesting chart, and it's from another real estate data provider called RealPage. They have a lot of great products. And let's look at how multifamily stocks up compared to some other things. So as of Q3 2023, the number one thing that had the highest delinquency were credit cards, right? Then auto loans, then HELOCs, then 1 to 4 families, so small multifamily, junior, and first liens. Then you see all these different things, right? Multifamily is all the way down here at the bottom, right above all other loans and foreign government loans. So the delinquency rate on multifamily has not been what everyone thought it was going to be. I think coming out of 2022 and going into 2023, we all thought there was going to be blood in the streets in 2024. And of course, things are still possible. We could see more distress, but as of Q3 2023, and then as we mentioned today, based on this number here, people are still able to pay their mortgage, and multifamily is performing really well, which is the historic norm. That is one of the things we always preach when we talk about multifamily to investors is it's a very resilient asset class. Having 100, 200, 300 units, you have a lot of people providing income. You have a lot of residents, right? And is it hard to manage these situations when there's a recession and cash flow drops and interest rates are high? Absolutely. But as long as you're in a position where you can continue to hold the asset, ride out the storm, and come out ahead, you will continue to benefit from the strength of multifamily, right? So just another great asset class. The other thing I want to highlight that this data is really telling us when it comes to all these economic data, we talked a little bit about how hard it is to buy a house right now, and a lot of people are choosing to rent from necessity, not necessarily from choice. I want to talk a little bit about absorption. So absorption is a term that we use better, sounds exactly like what it is. It's how many units are getting absorbed or rented, is another way of thinking about it, compared to the market. So coming into 2024, a lot of people were actually very bearish on apartments because they thought that there was too much inventory coming online and that we would not be able to absorb it. Well, if you have a lot of inventory, a lot of new construction coming online, and the market's not able to absorb it, what happens? Rents go down, right? Because there's new units, they're just sitting there. You have to give up concessions, you have to lower your rents. That impacts everyone, whether you're in A class, B class, or C class, right? So RealPage going into 2024 was forecasting, a 671,000 new apartments to be completed in 2024. So I want you to keep that number in mind, 670,000. Demand for multifamily has been substantial. So this is from a chart from Newmark, which is another brokerage that we keep a really close eye on. And this headline says demand surges in Q1 2024, rolling four-quarter absorption accelerates. Demand totaled 103,000 units in the first quarter of 2024, representing the largest first quarter since 2000, as well as outpacing the long-term first quarter average of 38,000 units by 2.7x. Additionally, rolling four-quarter demand accelerated to 317,000 units, the highest level since the second quarter of 2022, right? So 104,000 units were absorbed just in Q1 alone, which broke the highest record since 2000. It's the highest time that's happened since 2000, right? So even though we were going into the year a little bearish, thinking there was going to be too many units online, we weren't going to be able to absorb them. The market has shown that we are absorbing things in a very strong position, which is good for multifamily. And I think we've been talking a lot about, well, why is that happening? Well, we've talked about demand, right? So we're still continuing to see strong demand for apartments. So this chart is also from RealPage. It's from Q1 2024 data, so very relevant data, latest release data. It says Southern market continues to display strong demand. You'll see here, if you're I see some of my Houstonians here. Houston was number 5. So led by Dallas, Phoenix, and Austin, the South region accounted for 58.2% of demand for the first quarter in 2024. On a trailing 12-month basis, the South region once again led the way, and Texas occupied 3 of the top 4 markets in demand. Long story short, Houston, Dallas, Texas in general is in a really strong demand area, and we're still seeing a ton of demand. And again, this goes back to the affordability, which we're going to talk about here in a second. But the top 25 markets for demand in Q1 2024 was Dallas, Phoenix, Austin, Atlanta, Houston. And then the top 25 markets for demand, TTM stands for trailing 12 months, not just Q1, for the trailing 12 months. Houston was actually number 1, which is, again, makes us very bullish on Houston. There's still a lot of demand for rental housing in Houston, which again is impacting this absorption that we're seeing right here. And why is that happening, right? This is really important. And one of the reasons I am so bullish on rental real estate, whether you're buying single family houses or you're investing in multifamily, is economics continue to put people in a position where they're renting because they have to, not because they want to, right? So look at this gap here. These lines are so telling about our industry right now. So this gray line right here represents the total median monthly payment if you own a home. And I saw a chart a little bit earlier today, but I want you to think about this for a second. Going into COVID, let's just say Q1 2020, the average cost of owning a home was, it looks like about $1,500 a month if you draw a line from here to here, right? Right now, Q1 2024, that same home is $2,600. And there's some different charts out there. I saw 2,800 on another chart. I went with the one that was a little bit lower just to be conservative. But let's look at this other line. Let's look at the average effective rent for multifamily. Rent growth, we've seen a lot of rent growth. Everyone is investing in multifamily because of the tremendous amount of rent growth. Obviously, we saw some rent decline right here. This was during COVID. But we've seen strong rent growth, and it is a little flat. It is flatlining right now. So it's been a little tough to get rent growth because of all the economic stuff that we've been talking about. But we're still in a really healthy position. Why? Even if rent goes down a little bit, why? That's because there's a large gap between the cost of renting versus the cost of owning. This $800 difference is very, very, very huge for the average buyer. Look at the gap between renting and owning for the last decade, for the last 10 years, right? Going back to 2014, look how close these lines were together, right? And then boom, COVID hits, the real estate market takes off, Fed's money basically becomes free, and inflation takes off. And now the cost of owning a home just accelerates to a number we haven't seen this large of a gap in history. So this makes me very bullish on absorption, right? Why are all these new units getting absorbed? Why are people, absorbing them when they're finished construction? Well, this is why, right? Because the cost of owning is too substantial, which is leading to all this growth in these southern markets here. So people are renting by necessity and not by choice, right? And this is again just another thing to keep in mind as credit card debt grows and savings declines. The ability to buy a home just gets really, really, really hard, right? So this is a chart showing the amount of credit card debt that we have in the United States right now. And the gray line is consumer loans, so credit card and all of the revolving plans or commercial banks. And then this is the personal savings rate. So even though, as mentioned, the personal savings rate is it's not in a terrible position, it is much lower. A lot of money is in money market accounts, which we talked about earlier. But what's really telling is that loans and consumer debt is at a really uncomfortable position. Again, this makes it really, really challenging to buy a home, and it puts you in a position where you have to rent. So it's really good if you are in residential real estate or you're in multifamily real estate for all these economic indicators we're seeing here. So long story short, big question we're having today as we kind of wrap it up and open up to Q&A is it a great time to invest in multifamily? Is it a great time to invest in commercial real estate? And I think it is. Why? Well, one, to summarize, the Fed has made it clear that rates will be cut in September, right? So remember going back to that chart from Kalshi, there is a large percentage of chance, 36%, that we see two rate cuts this year, and only a 7% chance that we see no rate cuts this year. So there is a rate cut coming, right? We are on the tail end of this uncomfortable situation we're in, right? So the rates will be cut by September. Discounted deals compared to 2021 and 2022 pricing for a short window. So we have seen, and we didn't really talk about pricing today, we have seen a substantial amount of properties that are at a substantial discount compared to 2021. 20 to 25% is a pretty good norm. We've seen some north of 30% compared to 2021, 2022 pricing. So real estate is on sale. I don't know about you, but I like to buy stuff when it's on sale. I like to invest when it's on sale, right? So it's a great time if you want to invest when things are on sale and really come out ahead in 3 to 5 years. Single family homes are still overpriced for buyers, right? We just spent a lot of time talking about that and how it's almost impossible to buy your first home, especially if you're in your late 20s, early 30s, and you're looking to start a family. Buying a home is really challenging right now. We don't have a graph for this, but as I was doing my research, the average American needs to make $115,000 to be able to afford a home right now. That can be a dual income or a single income, husband, wife, right? Well, what's the median income in the United States right now? It's 75,000. So you need to make 115,000, but the average median income 75,000. Well, that puts people in a really challenging position because if you're below the average and you don't meet that 115, there's a $40,000 gap. It's one of the largest gaps in history between median income needed to buy a house and median income actually seen here in the United States right now. So it's gonna be quite some time before homes become affordable again. And owning residential rental real estate, whether it's a single family house or owning multifamily, is a great place to be. So invest now and sell in 3 to 5 years when the market is starting to boom again. So that's really the strategy right now. We talked a lot about a lot of economic data, both good and bad. There's definitely some data pointing towards an upcoming recession, right? We talked about rising unemployment. We talked about rising amount of credit card debt. We talked about the record amount of homes that are on the market that are not selling. We talked a lot about some things that were good as well in the market, right? We talked about how there's a lot of absorption in the market. A lot of people are still renting. We're still seeing, even though it's flat to slightly positive, we're still seeing average rent growth as of Q1 2024 in America was 0.1%. So even though it's flat, it's still slightly positive. It's not negative. There are some markets that have negative rent growth, but overall, rent growth is still really strong in America, despite all the negative factors that are weighing down on multifamily real estate potentially right now. So it's still a great time to invest. The best time to invest, again, is when things are on sale, when things are on the downturn, so you can really come out ahead. Remember, these are long-term investments. These are not 12 months or 18 months. These are 3 to 5 year investments. So if you could buy when things are on the down, but on the way up, we see Fed funds rate forecasted to be cut in September. That's going to put some pressure. It's going to start to kickstart the market. And if we go through a shortened recession cycle, which I think we will, I think we'll have a soft landing. We're still in a period where a soft landing is still very possible. If the Fed starts to cut interest rates like they're forecasted to in September, we'll go through a very mild recession, 12 to 18 months. And then we'll come out ahead, right? We'll start being in a position where buyers are back in the market, interest rates are more mild, jobs are starting to open back up, and selling is going to be in a really, you're going to be in a great position to sell anything that you bought 2 to 3 or 4 years ago, right? So great time to invest. So With that being said, I want to encourage everyone. If you want these slides, please again shoot me a text. But I want to encourage everyone to really follow the data that we talked about today, right? Not just don't just follow the headlines. I think that's really important to highlight, right? CNBC, Yahoo Finance, Wall Street Journal, New York Times. I mean, these are all reputable media outlets, but their job is to catch your attention with juicy headlines, right? It's not their job necessarily to highlight unbiased opinions or, I'm sorry, objective statements. So don't just look at CPI, don't just look at PPI, don't just look at core PCE. You have to look at all of them and understand how they impact the economy. And you have to also understand how they impact the commercial real estate space or the real estate space in general. So make sure you're doing your homework, you're doing your due diligence. You're following us. We put out data like this regularly in our newsletters. Make sure you're listening to us on these webinars as we kind of provide updates, and just make sure you're staying up to date with what's going on in the market. So if you want to partner with us on deals, please make sure you're a part of our private investor club. I see a majority of people on here are definitely in our club. They're people that I've talked to, but if you're not in our private investor club and you want to get access to in-person events where we talk about stuff like this in person, property tours, or other educational events, please sign up for our private investor club. I have a link here at the end. And if you're looking to invest, just one thing I do want to highlight is we do have an investment offering open here in the month of July. We're actually running a special on it. I don't have those numbers in front, but it's for our real estate income fund. This is an evergreen fund that we have open. It provides monthly dividends, monthly cash flow as we raise investor capital and we give out short-term loans to investors for fix and flip projects. So we have a private money lending partner. They go out and they give out loans, short-term loans, first position loans to investors. They flip houses and we charge them 12 to 13% interest rates, and we keep the difference on an arbitrage play, and we provide the returns to our investors. So if you want to invest in this fund, it is liquid, meaning you can get your money back in 90 days or less. Does have a $25,000 minimum for accredited investors only, and these are the types of returns you can get from investing. So anything below 100 grand is 6%. We do have a 1% bonus for the month of July for the first 6 months of your investment. Anything between 100 and 500,000 has an 8% return. Again, there's a 1% bonus on that for the first 6 months, paid out at the end of month 6. And then there's an additional bonus for 500,000 to a million or more. And investors are always paid first before we realize any type of profit. And you can let your money compound as well. So if you want to invest in this and you don't want the monthly distributions, you can actually leave it in and just let it compound over time, which is just a tremendous wealth building tool. So this is something we have open. It's evergreen. It's open all the time. I would encourage you to reach out to me. Scan this QR code if you'd like to learn more about it. It is a 506c offering for accredited investors only, but would love to talk to anybody who's got a little bit of cash in the sidelines that wants to put it into something that's generating revenue from income and diversified their portfolio. So with that being said, I hope everyone learned something today. We've got a couple of minutes here left before we wrap up. Does anybody have any questions? Please feel free to put them in the chat, or anything you want to discuss when it comes to economic data. I'm happy to share my opinion as well. All right, let's see. What do we got here? Open the Q&A. There we go. All right, first question. Does Headway have any open real estate opportunities, multifamily? Okay, so somebody's asking if we have any open deals right now. We don't have any open multifamily deals, but we are looking to acquire our next opportunity here before the end of the year. I would like to promise, obviously promising is hard, but we're looking to find our next investment opportunity before the end of the year, ideally before the holidays. So I promise you we're working very hard. So if you have not had a discovery call with me, please make sure you reach out, investor@headwaycapital.us, send me an email, send our team an email. We'll reach out and schedule a call. We do need to have a discovery call before you can invest in any of our projects. But we are working really hard to find something lucrative to put in front of our investors. So if we haven't chatted yet, please make sure, even though you may be on our list, which is how you got on this webinar, if we haven't had a phone conversation yet, we don't like to take anybody's money we haven't talked to. So please make sure you're reaching out for that. Do you think the Fed is going to aggressively cut rates? That's a good question. I don't think the Fed is going to aggressively cut rates. I think they're going to take a personal opinion. Now, some things could force their hand. What I think is more likely to happen is they're going to cut rates and then take a wait and see approach, and then cut rates and take a wait and see approach, unless something forces their hand. What could force their hand? rising unemployment, extremely low GDP, some sort of banking or financial crisis. There's a lot of different things that could happen, but my guess is they cut rates 25 to 50 basis points, which is 0.25 to 0.50, and get Fed funds rate below that 5% mark. And then maybe they wait a month and then they do it again and then they wait a month. I don't think they're going to cut rates as fast as they raise them, but I will say there's a very telling chart that I talked about on how the Fed always does stuff way too slow and ends up having to course correct to make up for their mistakes. This one here, right? So this one we talked about the Fed lag policy on raising interest rates when they're supposed to. I don't have a chart for it, but the same thing happens on the tail end. When inflation is rapidly dropping, the Fed waits too long to cut rates. Well, that's what typically causes a recession. How do you get out of a recession? You cut interest rates, right? So if we get into a position where we're in a bad recession, that's not a soft landing like they're hoping, they could cut rates aggressively, right? They could cut, I don't know if they'll cut them as fast as they raised them, but they could, right? So that's something that's really important to keep an eye on. They already made the mistake of raising rates too late. Will they make the mistake of cutting rates too slow? I think they will personally. But that's my sort of crystal ball on that. I don't think they'll cut aggressively. I think they'll cut gently, take a wait and see approach unless something else forces their hand. But great question. Great question. What impact do you think this will have on the residential market? Do you see a residential market crash? Kind of talked a little bit about that. Great question. I don't think there's going to be a residential market crash. And I alluded to why already. I think most people's house is an asset. And I don't mean that literally. What I mean is their mortgage is an asset. There's a very, very, very large percentage. I believe it's over 60%. Don't quote me on that. It's a very high number. It's over 50% for sure of mortgages, residential mortgages that are below 4.5%. Well, that's an asset. Why would you sell your house, get out of a 3.5, 4% mortgage to trade up to a 7% mortgage? It just doesn't make sense, right? Unless you absolutely have to. So the only thing that would cause, there is one thing I can think of that would cause a residential real estate crisis, so to speak, or sort of downturn. And one would be very, very, very high unemployment, right? So we talked about unemployment already here at the beginning, right? If we were to see very, very high unemployment, I mean, look at unemployment during the great financial crisis, right? 2008, unemployment takes off and it goes north of 10%, right? When that happens, you could see a real estate crisis because why? Even though your mortgage is super low and you have a low interest rate, 3%, 4%, well, you don't have a job. And if there's no jobs on the market, well, guess what? You stop paying your mortgage, right? So that could happen, theoretically speaking, right? Jobs fall off the radar. There's no jobs open. Unemployment shoots through the roof. Now I can't pay my mortgage. And we talked about the rapid amount of inventory on the market. So that's the trifecta, right? No jobs, rapid unemployment, large number of inventory. Could it cause some sort of crash? Yes, but I think the term crash is a little dramatic. I think it could cause a correction, right? So will that happen? I don't see that happening personally. I think the Fed will achieve their soft landing. I think unemployment will rise a little bit. I think it'll approach 5%, and they start to panic and they start cutting rates, which will then loosen up the economy, which will then spark jobs, which will help prevent the market from crashing. Will there be a softening on the market where we see prices decline 5, 10% because there's an excessive amount of inventory on the market like we're seeing here? Possibly. But I don't think that's the same thing as a crash, right? So a 5 to 10% drop is not a crash. That's more of a market correction. So great question, but I don't think there's going to be a residential real estate crash. So it's we're here at the top of the hour. I don't see any more questions coming through. So I just want to thank everyone for hopping on tonight. Again, if you want these slides, scan this QR code or text me 281-559-7061. You can also shoot our team an email at investor@headwaycapital.us. I want to say thank you to everyone for attending tonight. If you have any questions, feel free to reach out and have a great day.